In this video, I'm going to walk you through the exact blueprint I used to narrow the market down from over 50,000 tradable securities to just a handful of names worth trading on any given day. This is a no BS approach to becoming a better trader, and by the end of it, you'll know how to scan the market, ignore the noise, focus on what actually matters, and trade the right stocks at the right moments. Before anything else, you need to define what you actually trade. Are you trading stocks, options, futures? That single decision eliminates most of the market immediately. Here's a simple example. If you're trading stocks with a smaller bankroll, you realistically can't trade names like SNDK, MU, or Apple. The price movement relative to your capital just doesn't make sense. In that case, you're probably looking at smaller cap stocks, maybe even sub $1 names. If you have a smaller account and want leverage, options become a very valuable path. That's the route I take. I trade options on a daily basis. Once you decide you're trading options, one rule becomes a non-negotiable: liquidity. I trade options on mid to large cap stocks because liquidity keeps spreads tight and execution reliable. I can get in and out without fighting the market, and just these two decisions alone, what you trade and where you trade it, shrink the universe from tens of thousands of securities to a manageable subset. The next step is building a watch list. What matters here is not how you build it, but understanding what it is. A watch list is a living, dynamic list of stocks you're willing to trade, and it's not something you set once and you just forget about it. Names rotate in and out of the market as conditions change. A good example of this is during the meme era. 2021, stocks like GME and AMC, they were in play because they were moving. Today, they're largely dead money, so there's no reason for them to sit on my watch list. Over time, those names get replaced. Right now, stocks like SNDK, MU, WDC are relevant because they're active, liquid, and they're also tied to a broader theme. Understanding what is in play helps you build a watch list that is relevant and reliable. Now, the most powerful filter in this entire process is understanding what is actually moving. Opportunity comes in clusters. Yes, sometimes one stock moves on its own, but most of the time money flows through sectors. That is why I pay close attention to sector behavior: financials through XLF, energy through XLE, and then XLK. That's technology. The S&P 500 itself is made up of sectors, so when you understand which sectors are gaining or losing, you immediately narrow your focus to where opportunity is likely to show up. Within that framework, relative strength becomes very critical. Relative strength is simply a way to compare one stock or a sector against another and see where the money is flowing. If one holds firmly while the other one breaks down, that tells you where accumulation is happening. For example, if XLK is pulling back and making new lows while XLE is holding up and refuses to break down, well, energy is relatively strong compared to tech, and that tells you perhaps where your attention needs to be. Relative strength is just another word for accumulation. You can apply the same idea to individual stocks, and this is where narrative and relationships come into play. At the time of recording this video, memory is a key sub-theme within the broader AI narrative. AI needs memory. That's why stocks like SNDK and MU are showing momentum, volatility, and very clean trading behavior. And understanding this relationship between those stocks, it matters. If SNDK starts leading, then MU and WDC often follow. That relationship allows you to anticipate opportunity and pivot very quickly as price action unfolds on an intraday basis. Earlier in this AI cycle, the same relationship existed, but it was between names like NVIDIA, SMCI, and AVGO. The same concept, different phase of the narrative. And when those relationships start to break down, when leaders disconnect from the followers, that's a signal too. It tells you that the theme may be weakening and the rotation may be coming. Now we move into a slightly more technical side of things. I focus heavily on the weekly and the daily charts. They reveal structure, intent, and relative strength while cutting through some of the intraday noise. And as you get closer to execution, it becomes critical to understand who you are as a trader. Do you trade breakouts? Do you buy dips? Are you an intraday trader or a swing trader, or perhaps something in between? Breakout traders look for momentum, volatility, and expansion. Dip buyers look for discounts and meaning reversion plays. For me, I fall into the breakout category. I trade momentum. I like it when it's fast. I like when price expands. That matters because this is where the real work starts. Scanning, right? Scanning the market is an essential thing. This work can be done anytime, really, but on weekends or during slower market hours. I prefer weekends. I think it's the most powerful time to do scans and then supplement it during slower market hours. And so even if you don't remember every chart, your brain absorbs structure and behavior. You add alerts on the charts, you build familiarity, you move faster when it matters because of everything you've done. Now, as you apply everything we've talked about so far, your watch list will naturally narrow down. From there, you will build a focus list. A focus list is a very small group of names, sometimes just a few that deserve your full attention as the market is opening. Preparation makes it even easier to pivot. Some of the names you're excited about simply won't play out, and that's normal. What hurts traders is attachment. You have to stay flexible. Let the market move the way it wants to move and go where the opportunity is. Trying to control the market or stay loyal to a thesis they had will hurt you over time. If I'm excited about Nvidia or SNDK, perhaps even Tesla, and none of them are acting right in the first, let's say, 30 minutes or 1 hour, I need to reevaluate. The relevance drops quickly, and that's why preparation matters. Alerts are already in place, and I can pivot to where momentum is developing. This is where rotation, relative strength, and relative weakness come into play. One rule matters more than any other here. Trade what is moving. The market rewards responsiveness, not stubbornness. Clinging to what you thought should happen is one of the fastest ways to lose. Intraday relative strength matters the most. A stock that holds firm or pushes higher while the market pulls back is signaling demand. If you're a day trader, that's where your focus needs to be. Stop trading what's familiar. Not every stock is in play every day. An example of that is Tesla. When it's in play, you trade it. When it's not, you move on. Weak names need to be removed very quickly, and they either become downside candidates or they come off your list entirely. Once the bell rings, this becomes an execution game. There's still analysis, but this is where reflexes matter. You trade from a playbook. A playbook is a small set of repeatable strategies you've tested, refined, and you've learned to trust. There's no improvising here. It's no different from sports. A soccer player doesn't think about how to kick the ball in a match. They act based on years of repetition. That's how intraday trading should feel. One of my core playbook setups is previous day high or low. I won't go through the entire playbook here, but the idea is simple. How does price behave around these levels? Do we break and continue? Do we break and fail? Do we reclaim and trend? Once you've narrowed down the market down to strong names, your playbook tells you how to act. The best trades often leave clues. It often leaves clues the day before. That's why I always say that today's trades started yesterday. This entire process is about repetition and routine. And if you build it correctly, you'll be there when a stock moves.